Hello again from Core Wealth. This is the monthly wrap up to the end of February 2021. We'll have a look at some of the things that happened in February and then have a look forward to what our expectations are for the rest of this year. So Tito Mboweni and his budget were the big news in South Africa in February. It was a good budget. It ticked the box in terms of controlling government expenditure. They are projecting to limit the payroll increase overall by 1.2% a year over the coming 3 years. That's after a decade of higher than inflation increases, so that's very good to see. Actually, since October last year, when they announced figures for the medium-term budget, there's been more than 100 billion extra revenue collected compared to October. That's been positive and allowed them not to have to increase personal income taxes during this budget. The last thing that was of particular note was the fact that they in future will be reducing the company income tax rate. It's only by 1%, but that's on the back of them speaking about that for the last 2 years or so. So good news for companies, and that should incentivize and continue to incentivize companies to invest in South Africa, which is what we need for growth. If we have a look around the world at what happened, the big news in the US was Joe Biden progressing with the stimulus package to try and stimulate growth in the US, and that is going ahead, and we think that's going to add further growth in the coming year to the US economy. During the middle of last year, you would have remembered perhaps I was talking about different letters in the alphabet in terms of economic recovery around the world. There was a V-shaped recovery, a L-shaped recovery, a W-shaped recovery, a J-shaped recovery, all different types. The figures now during February have started to come out for the different economies around the world for 2020, and it's definitely been a V-shaped recovery. In other words, the economy shrank during the first half of the year, and in the second half of the year, as the virus got more and more under control, the economies rebounded again strongly. They would have shrank for the year as a whole, except for China, but most economies actually rebounded quite nicely, and expectations for this coming year are to see good economic growth. South Africa has been similar. In fact, as we're recording later today, the GDP numbers for 2020 will be released as a whole, and most economists are expecting somewhere around a 7% reduction in the economy for the year. Interestingly, Treasury, the finance minister is projecting a 3% growth in 2021 for the South African economy. Some economists are predicting as high as 5%. So we're expecting to see continued improvement in South Africa and around the world in economies in 2021. So February was the fourth consecutive month that we saw positive returns on the JSE. It was up almost 6% for the month. Listed property on the JSE was up almost 10%, and globally, global equity was up just over 3% for the month. If we look back over the last year, and this is almost to the day that we've experienced the first infection of COVID-19 in South Africa, we have actually seen the best place to have been was in the JSE. The JSE up over the last 12 months by just over 33%. Comparing that to global developed market equities and global emerging market equities, it's outperformed both of those peer groups. That just goes to prove the benefit of having a diversified portfolio. All of our clients' portfolios have offshore investments in them, but had you just tried to choose one market or one geography to be invested in, you do so at your own peril. And we've seen the benefits of this diversification over the last year. Another interesting thing that we've seen in markets has been the more valuation-driven shares on stock markets have come back into favor. They've been underpriced for a long while now. We've spoken about it once or twice in these wrap-ups. But we saw that turning around, and we've seen the benefits of that flowing through to clients' portfolios as more valuation-driven managers are getting strong outperformance of your more growthy type strategies that have become very overpriced in the last year. So as you'd expect, the more aggressive or long-term focused strategies have done well over this last year, as we've seen growth assets like local and global equities perform well. Our Core Wealth Balance strategy, our Core Wealth Flexible strategy, the most aggressive local portfolio, as well as our retirement growth strategies have all done really well, giving you returns of between 16 and as much as 22.3% return over the last year on our global, our flexible strategy. Our global growth strategy, the most aggressive global strategy that we run, has given you over 22% return in dollar terms over the last year, as it's taken advantage of growing equity markets around the world. And particularly in the last little while, both locally and internationally, we've seen good returns coming from our valuation driven managers who've had some strong outperformance over this period. Again, just emphasizing that challenges in the short term shouldn't result in knee-jerk reactions. One has to stick to long-term strategies and understand what you're looking for from both managers and asset classes, and you'll be rewarded for that. So let's have a look at 3 asset classes quickly, starting with South African equities. Companies on the JSE, on average, their earnings dropped in 2020 by more than 26%. Now going forward, we'll see those earnings improve as the economy opens up, and we've already started to see that coming through in company results. And the situation that you now have is that South African shares are looking cheap, and the earnings are going to continue to improve, and therefore you'd expect some good growth on the JSE listed stocks. JSE listed stocks are cheaper than their long-term average at the moment by a healthy margin. If we look at global equities, the risk around the world is that inflation is starting to pick up, particularly in the US, and we've seen the knock-on effect of that, because as inflation rises, interest rates rise, and that's generally bad for more growth type stocks. And we've seen that effect on the large tech stocks that could do no wrong in 2020 have come off quite sharply in the first 2 months of 2021. If we then have a look around the world, places like the UK, their stock market is looking particularly cheap, and we think that, and they're one of the countries that is doing the best in terms of getting their vaccinations done, and so we think there'll be some good tailwinds to be seen in the UK equity market. Japan, another country that has done well, their shares are cheap. They've come through Corona quite well from an economic impact, and we think that you'll see some good returns coming from there. And then lastly, as we've mentioned before, emerging markets look very attractively priced, and we think that we'll see demand for those kind of shares in this coming year, which should be good for portfolio. By and large, equity markets around the world are looking attractive, with opportunities in specific geographies. Lastly, if we touch on South African bonds, the South African bond market is looking very attractively priced. You can get almost equity type returns from a bond portfolio, and it's particularly attractive for international investors who can't get yield on most of their bond portfolios around the world. So we're expecting to see some more demand for those bonds, and that'll be good for bond exposure in South African portfolios. So the usual message is stick to your long-term strategy, and last year proved that again, as we've been rewarded for keeping our eye on the ball, focusing on how asset classes will perform over the longer term, and making sure we've got good managers to do that, and we've seen the rewards come through. I'd like to make a quick comment about medical aids, because Kim Matthews, who heads up our healthcare division, has had a number of questions from clients around some of the mergers that we've seen in that industry. Quantum Health and Medical Aid focus specifically on Sun International and Bidvest. Those two large companies has been taken over by Discovery. This isn't something to be concerned about. it is something that we have been seeing and probably will continue to see a number of the smaller medical aids being taken over by larger groups like Discovery and some of the other bigger medical aids. It doesn't affect your benefits, it doesn't affect the risk within our clients' portfolios. That's something that Kim and her team constantly look at, so nothing to be worried about. Thanks for taking your time to watch this. I trust it's been helpful. As always, if you've got any questions, please give your advisor a call. We'd love to answer them and also just to catch up with you. Thanks again. Until next time, bye-bye.